At the time of this recording, 10:30 a.m. Eastern Time on Black Friday, November 28, 2025, SoFi Technologies is trading live at exactly $29.10 per share. The stock is currently showing significant intraday strength, up approximately 2.12% from the opening bell, pushing through key resistance levels with volume already surpassing 7 million shares in the first hour of trading. If you are watching the charts right now, you are seeing a green candle forming on the hourly that is threatening to break the recent consolidation range. The market is open, the liquidity is flowing, and SoFi is actively defying the lower volume expectations typical of a post-holiday shortened trading session. Now, here is the tension between expectation and reality that defines the specific moment for SoFi. The general expectation, the narrative you will hear from the skeptics and the headlines scrolling across financial news terminals, is that SoFi has run too far, too fast. We are looking at a stock that has rallied massively from its April lows of around $8.60. The common belief is that with a price-to-earnings ratio sitting north of 50x, the valuation is stretched, the easy money has been made, and a pullback is inevitable as investors take profits before the year ends. That is what the crowd expects: a cooling-off period, a reversion to the mean, a sell-the-news event following their record-breaking Q3 earnings. But here is the reality, and it is something that requires you to look much closer at the order flow we have seen this morning and throughout November. The reality is that institutional accumulation is accelerating, not decelerating at these elevated levels. We are not seeing a distribution pattern where smart money dumps shares onto retail investors. We are seeing the opposite. The price action today, pushing past $29 when the broader market volume is thin, suggests a buy-the-dip mentality has shifted to a buy-the-strength conviction. The reality is that SoFi is no longer trading as a speculative fintech lottery ticket, but is being repriced as a legitimate, profitable banking powerhouse that is successfully stealing market share from legacy giants. The market is beginning to realize that the checking account is the Trojan horse for the entire financial relationship, and SoFi has effectively won that battle in 2025. Let's look at the immediate context of this movement. Just days ago, we saw significant volatility as the stock touched 52-week highs near $32.73 before retracing. That retracement to the $28 level was the test. Bears wanted to see it break lower. They wanted to see the momentum fade. Instead, we are seeing a resolute defense of the $28 line. Today's move back above $29 is a technical confirmation that the bulls are still in total control. This isn't just retail traders buying call options on Robinhood stock trading apps. This is sustained buying pressure. When you look at the recent 13F filings for the quarter ending September 30th, 2025, the data is staggering. JP Morgan Chase increased their position by over 800%, holding nearly 47 million shares. BlackRock and Vanguard upped their stakes significantly. These institutions do not buy millions of shares at 52-week highs if they believe the growth story is over. They buy because they are modeling out 2026 and 2027, and the reality they see exceeds the current market cap. To understand why this is happening, we have to strip away the noise and look at the engine driving this company. For years, the criticism of SoFi was that it was just a student loan refinancing shop masquerading as a tech company. Critics argued that without the student loan moratorium ending, they had no growth. Well, Q3 2025 shattered that argument completely. They posted record net revenue of $962 million, up 38% year over year. But the more important number is the bottom line. GAAP net income hit $139 million. This isn't adjusted EBITDA with a million asterisks. This is real profit. This shift from growth at all costs to profitable growth is the catalyst that changes how Wall Street values the stock. It moves the company from the basket of speculative high-growth tech into the basket of compounding financial compounders. The core of this success lies in their financial productivity loop, a strategy that many doubted could work. The idea was simple: get a customer to deposit their paycheck, the money product, and then cross-sell them into loans, investing, and credit cards. In 2025, this is working at a scale we have not seen before. Total deposits grew by $3.4 billion in just the last quarter to nearly $33 billion. Why does this matter? Because deposits are the cheapest form of funding for a bank. While other fintechs are relying on expensive warehouse lines of credit or capital markets to fund their loans, SoFi is using its members' direct deposits to fund its loans. This gives them a massive margin advantage. They are paying 4% or 4.5% to members, which attracts customers from traditional banks like Wells Fargo or Chase, who pay near zero, but they are lending that money out at significantly higher rates. This spread is pure profit margin, and it is a structural advantage that is incredibly difficult for competitors to replicate without a bank charter. Speaking of competitors, it is crucial to understand where SoFi sits in the landscape. If you look at the self-investing space, you have platforms like Robinhood, which dominates the active trader niche. Robinhood stock trading is fantastic for options and crypto, and they have expanded into credit cards and retirement, but they lack the full banking charter infrastructure that allows for the depth of lending SoFi provides. Then you have the legacy giants like Fidelity Investments, Fidelity Wealth Management, Fidelity IRAs, and the Fidelity Trading Platform are the gold standard for older, wealthier cohorts. They have the trust and the trillions in assets, but their user experience often feels dated to the digital native generation. SoFi sits perfectly in the middle. They offer the sleek, mobile-first experience of a Robinhood app, but with the comprehensive product suite of a Fidelity brokerage. Consider the SoFi Invest platform. It allows for the buying of individual stocks, whether you're looking at Tesla stock, Apple stock, or Nvidia stock. But it also offers automated investing similar to Schwab Intelligent Portfolios. This robo-advisor component is key because it captures the passive investor who just wants to set it and forget it. By offering both active trading and automated wealth management under one roof, along with a high-yield checking account and a credit card, SoFi creates a lock-in effect. Once you have your direct deposit hitting SoFi, your automatic savings going into a vault, and your IRA set up on the same screen, the friction to leave becomes incredibly high. This sticky ecosystem is why their member base has exploded to 12.6 million people. They added over 900,000 new members in the last quarter alone. That is almost 1 million people every 3 months deciding to decouple from their old bank and join the SoFi ecosystem. Let's shift gears to the technology platform segment, often the most misunderstood part of their business. This consists of Galileo and Technisys. Think of this as the AWS of fintech. Galileo provides the API infrastructure that powers other fintechs. So when you use a different neobank or a B2B payments platform, there is a good chance the back-end card issuing and processing is running on SoFi's rails. In 2025, this segment is finally starting to re-accelerate after a slower 2024. They're winning enterprise clients, traditional financial institutions that need to modernize their tech stack but can't build it themselves. This is a high-margin, recurring revenue stream that diversifies SoFi away from just being a consumer bank. It makes them a technology infrastructure play. If the fintech sector grows, SoFi grows even if those fintechs are competitors on the consumer side. It's a brilliant hedge. Now, I want to pause for a second and get a pulse on the room because the sentiment on this stock is usually incredibly polarized. Comment below how many shares of SoFi you currently hold, or if you are waiting for a pullback to enter. Are you in the camp that thinks $30 is the ceiling, or do you see this hitting $40 by mid-2026? I read every comment, so let me know your position size and your average cost basis down below. Back to the analysis. We need to talk about the lending business because it is still the primary revenue driver. For a long time, SoFi was tethered to the fate of student loans. When the government paused payments, SoFi suffered. But in 2025, the student loan business has normalized. But the real story is personal loans. They have originated billions in personal loans with incredibly high credit quality. Their average borrower has a FICO score well above 750 and a high income. This is not subprime lending. This is prime and superprime lending. The fear or the expectation was that if the economy slowed down in late 2025, defaults would rise and SoFi would get crushed. The reality has been that their credit performance has held up better than almost anyone expected. Their losses are within their modeled ranges, and because they sell a portion of these loans to investment partners while keeping some on the balance sheet to collect interest, they have managed their risk exposure masterfully. We also have to consider the macro environment. We are currently in an environment where interest rates have stabilized. The Federal